Hey traders, this is Blake Morrow with Trader Summit, and with me today for the very first time, I have Mr. Stephen Van Metre, and I am so excited to have you here, sir. Thanks for joining us at the Trader Summit community.
Blake, it's a real pleasure to join you and your audience today.
You know, I've been a fan. I was telling you earlier, I've been a fan of yours for the last, put my finger on it, probably the last at least 6 months. I've been watching a lot of your videos. I love your content. And I love where you go with it, because what I've noticed, me personally, is that you tend to see a lot of reports. There's things in the markets that get your attention, and then you interpret what you've read, and then you back it up with a lot of data. So how do you go about your analysis in the markets typically?
Well, yeah, I just kind of start with what's going on, and it doesn't make sense because I think that's a big problem out there. People hear the news and they hear a response to it, and they go, "Wait a minute, my wallet feels differently about it than what I'm being told." Like, oh, there's all these jobs, and why can't I get one? And so I just kind of take it from just the average person's view of how does this really work? How does this stuff really affect me? And maybe it's not the way everyone thinks. And when you start looking at relationships, and you see I use a lot of charts in my YouTube show to show people, look, if you want to know where things are going, look at these indicators. When this starts to happen, well, there's some other effects that start to occur. And I think it's just a matter of opening people's eyes to perhaps they already know how the world works. They just don't know it. And that's what we try to do, is really show them that, hey, what you think is probably true, but let's show you those relationships and what they mean going forward.
Yeah, it is really interesting, because I just like talking about some of your more recent videos. You were doing one on Jamie Dimon and JP Morgan, and some of the messaging that was coming across. And I think it's important that you take that information and you have really broke down some of the key elements to really explain it to the average investor. And I love it. And I think it's really important for the investment community. So thank you so much for doing that. But I wanted to ask you, Stephen, what is, in the last couple of months, we've obviously been in a crazy market. We've seen equities drop a precipitous amount. We've had a nice bounce this summer. But overall, things feel pretty dicey. So what's probably the things that have really got your attention over the last few weeks, maybe, that really stick out like a sore thumb, that might even keep you up at night?
Yeah, so let's talk about maybe why the bounce happened first. I think that's a good place to start because, the sentiment's pretty bearish. People are kind of looking out the economy. They're seeing unemployment claims rise, and all of a sudden the market kind of takes off. And, one of the things I like to sit back and take some time to try, like, why did this happen? Was it because we had some technical thing and it was a bunch of traders coming in? Was it, computer algorithms? Or maybe it was even something more simple than that. What did we hear from all these policymakers? Stop and let's say, what did the Fed tell you? Hey, it's not that bad. This is just a little slowdown. What did the White House say? Oh, well, that definition of a recession, it's interpretive. And right. But hey, but good news, the official people that call recession, they haven't called one. And by the time they do, well, we're probably out of it anyways. What are we hearing from the analysts at those big commercial banks? You talked about JP Morgan. What are they all telling you? Oh, it's just a slowdown into summer. Don't worry about the data. And so all of a sudden, what did we see in the data? That bad news was good news. And, that should always caution people when you're in the early stages of a bear market, when all of a sudden that, kind of flips of bad, you want to see bad news being bad news, but when bad news is good news, what is it trying to tell you is that the market is buying into what they're being told, is that this is the worst. And so, is behind us. So we're getting this kind of lull, the eye of the storm, so to speak, is kind of right, is what I'm seeing right here, right now. And what I'm looking at, Blake, is kind of more the leading indicators. We got the Philly Fed data out today. We see new orders are contracting at a little bit slower rate. We saw the Empire State Manufacturing Survey just absolutely crush, debt to the downside. We see initial claims, softened up a little bit, but they're still, arcing, kind of trending upward. So So you see that the market is getting real excited and saying, okay, well, maybe this is, the bear market's over and we can get in this. And then the problem is the data is suggesting that no, that's not the case. The Fed is still tightening. They're still going to raise rates. Even if they slow down, that's not a big deal. They're still doing quantitative tightening. And oh, by the way, next month that gets doubled. And, that's usually not good because, it was QE that you said caused stock prices to go up. So if QT, must have some opposite effect. Well, that's getting doubled here. So I think a lot of what it was retail investors, money managers, everybody was playing chase. And we've seen this happen before. When you're in a bear market, that chase gets unwound. Wherever it rings a little bell, and it happens to be around the 200-day moving average. Coincidentally, the S&P 500 tags its 200-day moving average. I know a lot of your viewers know that. And that in the past has been an indicator to start looking to the downside because that's probably the next direction.
It's interesting how you point that out, and there's definitely some technical indicators that are converging right on these areas that we are sitting at in the markets. But a lot of the markets, as you pointed out, sentiment, positioning, and I think you're exactly right. You nail on the head. But what a lot of people are looking at. Let's just talk employment really quick. We can also talk a little bit about inflation, but employment, is still pretty strong. What do you think it's going to take, and what are you seeing that might suggest that we are maybe softening a little bit more in employment?
Yeah, if you're referring to the employment strength by the non-farm payroll report, I'm not a big fan of the non-farm payroll report at all. In fact, it's one of those reports where I think is almost humorous, but the market literally just sits on, its tippy toes, like, okay, here it comes. And what we know about that, what we've learned from our friend Jeff Snyder, who is part of our Markets Insider Pro team, he wrote about this recently, and we talked about it on his show, is that the non-farm payroll report is really designed to be smoothed out. So it's not designed to have big moves higher, big moves lower. And if it trends down a little bit too quickly, what you notice going into recession, it actually pops back up. And he said it's by design of how the non-farm payroll report is constructed. It's not government manipulation. He said it's just designed to smooth out. So he says it's very normal. You see this pop in payrolls, but the problem is, Blake, is you look at initial claims day and you see that 4-week moving average is slowly moving up, and it's telling you that, hey, whatever's going on in the non-farm payroll report is probably not all that accurate, because we know that initial claims data is actually, it's revised a little bit, but overall, someone makes a claim, they're counted. Non-farm payroll report does have some, seasonal adjustments, the birth death model, the government, massaging. So I look at the pop in the non-farm payroll report and I say, it's very consistent with us heading into recession. And on top of that, you look in the news and what are you hearing? Companies laying off more, or what do we hear in Apple? We're getting rid of our, recruiters. Well, gee, I wonder what that means. Like, right. They're getting rid of the people that are hiring people. Well, that must not be good. And then again, it comes back to you're looking at the economy. They're looking at their job. They're hearing their employers, talk about how orders are slowing down, demand slowing down. And you hear the government's like, wow, look at all the jobs created. Well, the reality is the non-farm payroll report does lag going into recessions, and it actually can generate jobs going into early phases of recession. So as far as it as an indicator, I'm not a huge fan of it.
Okay. Yeah. And that makes a lot of sense. And again, this is part of that information that you give your investors, people that listen to your channel and listen to your YouTube videos, really start to get an understanding. It's like, oh wow, I have to start looking at the employment component of the ISM, or what are the PMIs telling us? It's so vitally important. But let me shift over to inflation. Are you in the camp that inflation has peaked? And if you're not, what are you seeing that's got you questioning that?
Yeah, that's good. I've said going into the last CPI report that if the peak wasn't already in, gosh darn it, we've got to be super close to it. I'd say right now, looking at the Philly Fed prices paid data that came out, it's a pretty good indicator. Even though prices paid are still rising, there's just not as many firms reporting higher prices. That's usually an indicator that not only are interest rates headed down, but also the consumer price index. We see new order growth falling. That's also another good indicator that consumer prices are headed lower, as is demand. You look at crude oil, gasoline prices, put those on a year-over-year comp against the CPI. They're all telling you that even if there is one more higher print, and there could be. I don't want to go out and say that it's not impossible for something to trigger that, or the government does some seasonal adjustment and it pops up. If we're not at peak, we're pretty close, because all these things, particularly on a year-over-year rate of change, are declining. So my outlook is inflation is indeed headed lower. And then again, we already see some other things, Blake, right? We've got the yield curve inverted, we've got the Euro-dollar futures curve inverted, and those things are really great indicators of telling you that the probabilities that inflation is coming down are really high.
Yeah. Do you think we're heading into a stagflation environment if we're not already there right now?
No, I don't. Okay. So I really am not a big fan of stagflation in terms of the overuse of the term. What happens is, going into recession is you have this, and we do have brief periods of stagflation. And just so everyone understands, how my interpretation of stagflation is rising unemployment and rising inflation. So we're just seeing unemployment start to rise a little bit. We've already seen the inflationary effects. Everyone keeps thinking 1970s, where you have rising prices and rising unemployment. Well, now the modern economy, when you get rising unemployment claims, what happens is people lose their jobs and they don't have as much income. Now, during the pandemic, people, lost their jobs and had more income. Well, under very normal conditions, you lose your job, you have less income. Anyone who's been on unemployment already knows that. Well, if you have less income, you consume less.
Yeah.
And that's exactly why you see, as unemployment claims go up, inflation with a lag, it'll come down. The idea that we could have a long period of stagflation is highly unlikely, particularly with the inventory overbuild that we've seen. Even though I know Target and some other companies are coming out and say, well, it's not that bad. Well, yeah, I'm sure it's not. I'm sure it's way worse than you want us to believe. But the idea that we would have an extended period of stagflation is unlikely. In fact, we may be almost through the worst of it as the CPI starts to roll over and come down now.
That is interesting that you say that. Well, one other topic I really wanted to talk to you about, just because it's a recent video that I saw of yours just actually a few days ago regarding China. And China's economy is obviously slowed down. And, obviously we have an election coming up this fall for Xi Jinping. And, how does that man shift and navigate through an election cycle with a really weakening China, and how's that going to affect the global economy in your view?
Yeah, well, I mean, do you think the elections in China are honest?
Well, okay, so it's going to be a slam dunk. We got that.
I mean, if he's not reelected, I figured that they certainly didn't cook the ballots right. I completely expect him to be reelected. Who knows? Maybe anything can happen there. But the real issue with China is just a sign of what's going on in the global economy. And we saw the slowdown start somewhere right around March. And why is China interesting is not just because their housing market is looking like it's going to blow up and perhaps be the catalyst for another global financial crisis. Is you start looking at, from the macro perspective, if I here in the US am cutting back on my orders, well, who is going to see that? Well, the manufacturer. Well, where is a lot of goods manufactured? Well, China and other countries in Asia. Well, if you start to see their economy slow down, well, there's a reason. It's because ours is in an earlier stage. So they see it first. So when I start to see countries like China slowing down and start to have problems outside of the fact that they've got their COVID lockdowns and all their other draconian things going on, that aside the fact we're seeing their manufacturing sector slow down, that tells me when I see these Fed reports and ISM reports that say new orders are falling, yeah, that's true because I can see it there. So the slowdown starts in Asia and then starts to move across the world again. And that's why, and everyone gets excited when China starts to rebound, because what is it telling you? Well, they're the leading indicator of the countries in the global economy that as demand picks up, well, what's going to happen, right? Calling, hey, I got an order for you. Hey, all right, turn on the machines. Let's go. So that's what's interesting about China. The problem, the challenge there is they're just dealing with this massive dollar shortage. They're being forced to sell off their treasuries. Their housing market is effectively a Ponzi scheme that if the economy doesn't turn around, that they're probably the first shoe to drop.
It's and it, a lot of people look around and they try to figure out, okay, what could be the black swan event, if you will. But really, China is something that should be on everybody's radar, and I think you'd agree, because it's such a global force. I mean, it's what, second largest economy in the world now. But
yeah, I mean, if you don't mind, Blake, I want to come out of the housing market, because I don't think people understand, like, why is the housing market in China so much different than, say, the U.S. going into the great financial crisis. Is here what happened is inflation just got too high. We saw, of course, interest rates go up that caused a lot of adjustable rate mortgage rates to go higher, payments went higher. But the reason that we couldn't afford those payments is because incomes didn't grow fast enough, and so people had to pick between what they're going to pay and what they weren't, and they stopped making payments. This is not the same thing as happening in China. China's real estate system is a property market is effectively a Ponzi scheme. So you give a property developer money to buy a home. They haven't built it, but you effectively close escrow on it, and you own it, and it's not built yet. So you start making monthly payments. Now they, as property developers, have to continuously bring money in to finish building these units that they're already sold. So I already own, but I can't move in. Now the problem is the developers have run out of money, and you have the people that own them are saying, well, why am I going to keep paying on this deal? Because it's obviously, it's not done, and you don't have money to finish it. That's a completely different story. And you start to look who's in the middle, right? Who on as both the property developer and the buyers are at odds, who's sitting in the middle? The banks. So what do? Do you lend more money to the property developers who are flat broke, and you're not sure, are they going to use some money, to pay on their debts? Are they going to finish these properties? And then if they do finish the properties, are these buyers, is the economy going to hold up long enough where they're going to be able to keep those properties and make payments? And the answer, that's the big question. The global economy slowing down, both sides are at odds, and the banking system in China is dead in the middle.
And I forget the name of the developers, where this was already percolating several months ago as things were good here in the US, and you'd probably know the names right off the top of your head, but that you feel that could really be another issue that we should all be paying attention to.
Well, yeah, it's a huge issue, because if their financial system starts to crumble, that will be felt all around the world. If people think, oh, I'm immune to it, odds are that mutual fund or ETF or something you own somewhere, or maybe some bank here lent money, somebody's got some counterparty risk somewhere in the system. But the problem we see from a broad perspective is, when you look at the global economy, you want, if a country is going to go into recession, you want to have, everyone else not be in a recession, so they can kind of buffer that. But what actually happened? You said, what keeps me up at night? I'll tell you, Blake, this is real simple. We had a global pandemic. We shut down the entire global economy. We brought everybody back to the same starting point. Now, granted, certain parts of the world opened up because of how the virus, went through around the world. So some places opened up a little bit sooner. But again, we're talking, hey, we're in a foot race and I got a 1 second head start. I mean, nobody cares. You might be faster than me anyways. So the problem now is we had this effective reset back to zero. We all came up off of it. And then all of a sudden inflation took over. Central bankers are starting to pull all their support, raising rates, quantitative tightening, all of these pandemic stimulus, direct to consumer checks and business checks, and those are gone. And now the global economy is going to make it. And all of a sudden it's all slowing down together. And that's the fear, is if we all go down together, who props each other up? The answer is nobody. And that's the scary thing, is China. I mean, nobody's left to hold up China's real estate market, the US economy, look at Europe. I mean, you look around the world, like, man, who's going to hold up the global economy? Nobody. That's the problem we have right now. We started together, we'll go down together.
So I love how you're putting this all together for the investor and the trader. So let me ask you a couple of real quick questions before we go. Yeah. Where do you want to be? How do you take advantage of this? And where do you definitely don't want to be? What are your thoughts?
Yeah, good question, because whether you're a trader or an investor, or maybe you are both, you have money you trade, you have money you invest. So your longer term money, you look at the yield curve. You got an 85% probability we're going to have a recession. Eurodollar's future curve has 100% time it predicts lower inflation, lower interest rates. How do you play that with your investable money? You want to be sit and park in treasuries. Go long as much duration as you feel comfortable with, or as less as you feel comfortable, but study the yield curve, because what is it telling you? rates are coming down, inflation is coming down. Now, if you're a trader, well, you got some other things you can look at. You could, maybe be long the dollar. You could be short the energy sector. I know Tracy Schuchart would probably be shaking her head, but but we both agree that if we go into recession, energy comes down and then goes up. So again, trading short term. You want to look at the dollar. You maybe want to be short the equity market here at some point. So you want to be looking strategic with your trades, but you don't want to do some of those bigger trades with your longer term investable assets. There's just too much risk if you're wrong.
And quadruple long leveraged China, I'm assuming, is a good trade. I'm joking, everybody. Joking. But Stephen, I tell you, I really appreciate the information that you give to your listeners, to us here at Traders Summit. And you put together something with Tracy Schuchart and then also Mr. Snyder called marketsinsiderpro.com. Can you tell us a little bit about that?
Yeah, and so we combine forces. Jeff is our macro guru. He writes strictly about the global economy, the macro, the plumbing of the system. Tracy, our energy and materials expert, and then I've got a report that screens through ETFs and runs various momentum screens over and tries to identify short and long-term trades, and it does a really great job. But you get the three of us together: Jeff's daily, Tracy's weekly, my daily screening report, which is going to get a lot better in the future. Right now it's free, and then when it does go paid, hopefully in the next month or two, it's going to be ultra cheap for those that get in early. So it's a bargain. I would pay just for Jeff and Tracy's advice, excluding my own, because I think they're so wonderful. But you get all three of us. So check it out, marketsinsiderpro.com, free for a limited time. Check it out, and hope you enjoy it.
Yeah, you can't beat free. So everybody, make sure you get into that, and I'm going to have a link in the description of this video. Steve, I want to say it's been a wonderful time chatting with you. I'd love to catch up with you maybe here in the next couple months as we head towards maybe the Santa Claus rally. We'll see where the markets are at that point. Does it sound good?
I would love to.
All right, Steve. Well, thanks for joining us today. And if you liked what you heard here, make sure you subscribe to the channel so you don't miss any of our exclusive content. Give Steve a big thumbs up as you would on his channel. Thanks for joining us, and we'll catch you next time. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.